It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a shocking bombshell announcement exposes a major country is on the brink of total economic disaster. But it's not just one country, it's three. And as you're about to see, one of them is the United States. Plus, we have a sponsor for today's show. I'd like to welcome FlexShopper to the show. They're leased to own as an alternative payment solution. And you want to check them out on the NASDAQ under symbol FPAY, because I'm going to show you how to make a quick 23% return on your money. This is a chart setup you don't want to miss, one that'll put you buying below the insiders. Now, let's head over to Bloomberg, where we picked today's story up with the headline, as President Xi warns of obstacles ahead in the first speech after stimulus plans. And this is something we never hear from the political elites, let alone a president of a major country admitting to the citizens that there's going to be obstacles despite the fact that they're unleashing massive amounts of fiscal and monetary stimulus onto the economy, which just goes to show how close China's economy is to total economic disaster. We must be mindful of potential dangers and be prepared for rainy days, she said on Monday on a speech marking the 75th anniversary of the founding of the People's Republic of China. And again, when a head of a country or any political elite, whether in the banking industry or politics, when they come out and tell you that things are going to get worse, despite the fact that there's going to be a massive amount of stimulus unleashed, it shows you that the economy is in far worse shape than anyone wants to believe. And this is dangerous because China's success is dependent on the rest of the world. The issue is they know the stimulus isn't going to work. We told you it probably won't. We're going to give you all the evidence. The road ahead cannot be smooth, she said. There will be obstacles and difficulties, even major challenges like surging torrents and storms, suggesting that the Chinese economy, despite the huge reaction from the stock market, is about to enter a recession and things are going to get far worse. The reality is they're going to head into a depression. He doesn't want to admit it, but the fact that he's throwing such massive amounts of fiscal and monetary stimulus at the economy suggests that they realize that the only path for them now is down. And China's economy has been slowing as a prolonged housing slump, weak domestic demand, and falling prices, that's called deflation, combined to put this year's growth target increasingly out of reach. We'll just say impossible. It remains to be seen whether the announced support and promised increase in spending means a lasting turnaround is underway. And the reality is it isn't, because China is the world's largest exporter, so they're heavily dependent on the global economy. What we know is they have enough citizens to drive plenty of domestic consumption. They just don't. And all this easing is not going to turn out to be a massive spending by consumers. You're going to watch all the stimulus get saved and used to pay down debts instead of going to the economy, which means China is now dependent on everyone else. And at this time, we see the global economy weakening, suggesting China is going to head into a recession very soon, if all out depression when their banking system crumbles. She knows what's coming. The question is, can he put it off long enough to see the global economy turn around? Well, I don't think so. The pessimism was palpable before the stimulus announcements, with Chinese consumer confidence falling in August to the lowest level since November of 2022. And of course, we know that when consumers lose confidence in the economy, they stop spending, they start paying down debt, they start saving money, which is what we've heard Chinese consumers are doing. We'll talk about why this is here in a moment. These figures released earlier Monday showed that industrial activity contracted for a fifth straight month in September, highlighting the urgency for Beijing to act. But one of the problems is, as the world's largest exporter, well, they're dependent on the rest of the world. So if they're seeing their industrial production contract, it's because there isn't demand from everyone else, meaning China's stimulus isn't going to work because it's not going to go into the pockets of consumers that are likely to spend. But if you're looking to capitalize on an opportunity, let me show you this chart for FlexShopper. You can find them on the NASDAQ under symbol FPAY. I'll show you later in the show. This orange line is where the insiders have recently bought, and right now the stock is trading right around $1 a share, deep in the supply zone. And I want to see And I want you to see that every time it's traded down here in the last 6 months, it's rallied 23% or more right up to that orange line, setting up a tremendous opportunity for you. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's take a look at really what drives consumer sentiment. As we look at the U.S. data here, we have the University of Michigan Consumer Sentiment Survey in red against the unemployment rate. So what we see is sentiment declines as more and more Americans lose their job and get stuck on unemployment, and they start to believe that there's not going to be any opportunity for them. So naturally they cut spending, and that makes perfect sense. You see that happen here in the early 90s, and then the relationship gets even tighter going into the dot-com bubble as you see the unemployment rate rising as confidence falling. You see it again during the global financial crisis. This time we see the unemployment rate rising, and yet at the same time we see consumer confidence rising. The question is, why is that? Well, there's hope. American consumers bought into the soft landing narrative. Now they're buying into rate cuts are going to save the world. And the problem is, what we're going to see here is as the unemployment rate continues to rise, what's going to happen is confidence is going to tumble. It's going to take spending with it. And with American savings rate already at very low levels, watch debt service costs get paid down, watch savings rates go up, and watch the United States follow China right into the same path they're headed. The issue is, will stimulus save us? Well, we're not there yet. But one day we're going to see it in the not too distant future, because China's weak factory activity shows the urgency of stimulus push. The problem is, again, their factories are reliant on the global economy, which is slowing. The official manufacturing purchasing managers index was at 49.8, meaning the sector has now been in contraction since April of 2023, barring 3 months. The non-manufacturing or services PMI fell to the lowest in 21 months, showing construction and services activity lost momentum and moved to the verge of shrinking. And remember, many people believe that the global services sector would push the manufacturing sector out of a recession. What we've been saying is, where manufacturing goes, services follows, because if you don't have enough demand in the manufacturing sector, eventually factories start to lay people off. And those high-paying jobs, those workers, well, they stop spending, and that impacts the services sector with a lag. We're seeing that exactly happen here in China. But let's talk about why the stimulus in China is not going to work. Is because what they need to see the unemployment rate turn around there. And keep in mind, one thing we've known is youth unemployment rate in China is sky high. There's no opportunity for young people. But look at this relationship. As we go back to the U.S. data, you've got the unemployment rate in blue, but you see manufacturers' new orders of durable goods in red. They're shown on a year-over-year rate of change. And when you see decelerations in this, it typically impacts the labor market. As you can see here, right around 1995 and 1996, it slowed down that decline in the unemployment rate. It hit it again right around 1998. And then by 2000, it was game over as we see a contraction in new orders as it head below that horizontal black line. The unemployment rate went higher. It happened again during the global financial crisis, and we see the same relationship starting now. And this is exactly the issue of what's going on in China. Workers are seeing a lack of demand. You know, they go to work, the fax machine's not running full of new orders. They're seeing the backlog get burned away. And all of a sudden they realize that if there isn't an influx of new orders, they're going to be on the unemployment line as well. This is what Beijing realizes. The problem is they believe that they could pump money into their own economy, stimulate domestic demand. The issue is it hasn't worked in the past. It's probably not going to work now, particularly at a time when the global economy is slowing. And what are we hearing from factories out of Germany? We're hearing factories out of the United States. The capacity is actually declining because there is too much supply and not enough demand. There's no way the stimulus is going to save China. The PMI suggests that the economy is still weak, but there will be more focus on the impact of strong stimulus measures announced over the past week. The monetary and fiscal policy mix should prevent the economy from further weakening in the near term. And all it's going to do is send stock prices higher, at least for the short term, until the reality kicks in that what President Xi Jinping said is, look, we're going to see more storms here. Things are going to get worse. And the reality is he already knows the data for their economy is going to continue to get worse. And when the stimulus doesn't do anything, watch out, because that is the biggest risk policymakers face today, is what happens when stimulus no longer is effective. It means the entire world is headed into a globally synchronized recession, and that's the best case scenario. The lack of effective domestic demand is a serious problem, and the pressure on employment and weak expectations have constrained consumers' ability and willingness to spend. And that's the key point, because we've heard Chinese consumers, they're saving more money, they're paying down debt. It's going to happen in Europe, it's going to happen in the United States. When people start to realize that their job isn't safe and they're likely to lose it, and if they do, they know from friends who have lost their job that there's no opportunity. You're going to watch people build up their savings, pay down their debt. But the problem is it's too little too late, because when you lose that consumption, well, as we're already seeing in China's factories, it's too little too late. And China's property shares soar after big cities ease home buying, looking to create any sort of effort to put money in people's pockets to try to drive demand here, as the central bank's decision to refinance existing mortgages expected to now lower borrowing costs by as much as $5.3 trillion in mortgages for millions of families. And if you don't think during the next recession the Fed's going to lower rates back down to zero to try to get all the people that bought homes at higher interest rates to refi down to free up cash flow, they're going to do that. The problem is when people lose their job and get their hours cut at work, the banks aren't going to lend anyways, and that's one of the dangers here. Is the move, confirming earlier reports, underscores China's urgency to stem a housing-led slowdown, which we warned about, in Asia's largest economy, as it faces the prospect of increasing protectionism and a shaky global outlook. The reality is they're just a victim of a massive slowdown in the global economy. China here has nothing they can do. For years, they've been trying to stimulate local domestic demand. It's not worked, and this time it's not going to work either. Last year's mortgage refinancing push reduced outstanding rates by an average of 73 basis points and lowered borrowers' annual interest expenses by 170 billion yuan, and yet it did nothing. This is the evidence I wanted you to see. China has done this before. They put more monies in people's pockets, and what happened? We're still in the same place. In fact, it's only worse. They're going to do it again, hoping this time it changes. But again, put yourself in the position of one of their factory workers. They're not seeing the demand come in. The government says, hey, we're going to increase your cash flow every month by a little bit. And what are you going to do? Save it and pay down debt. That's what happens. And most of the time, half of all stimulus actually gets saved, believe it or not. This time, I think it's going to be even more. There's no chance that China's move here is going to stimulate their domestic economy. The government also extended one of its 2022 16-point rescue package measures till the end of 2026. Get this, allowing developers outstanding bank loans and trust borrowings due within the next 6 months to be extended for a year. This is what you call pretend and extend. You hope things are going to get better by pushing the debt out, forcing the banks to not foreclose on this debt, to not put it into delinquency, and hope the economy turns around. But there's a point here, is if you do stimulus and it doesn't work, and you push all these loans out and nothing happens, well, the situation a year from now is going to be far worse. And that's optimistic, considering I don't think the Chinese economy is going to make it through the next year. And the PBOC doesn't buy it either, because they just ramped up net purchases of sovereign bonds in September. As the People's Bank of China said in a statement, the operation was aimed at keeping the banking system liquidity reasonably ample, which you shouldn't need if your economy is in good shape, and strengthening the counter-cyclical adjustments of monetary policy. The central bank didn't specify the tenor of debt it purchased this month or when the operation took place. Last month, it bought short tenor government bonds and sold long tenor notes. This time what we're going to see is, of course, is the government is actually borrowing money from the public, from the banks of all places, and then turn around and injecting cash right back into them. Banks eager to buy the government debt because they want the yield on it, and the government then eager to put the money back into the banks to show the public that the banks are liquid, and there's no reason to trigger a bank run here. But all this tells you is something with China's economy is about to go wrong, and in a big way, and President Xi Jinping admitted it. The problem is, for the United States, something's about to go wrong. Well, tonight at midnight, as with port strike imminent on the East Coast, Gulf truckers, rails are scrambling to move billions in cargo before the midnight shutdown. And here's the problem. No negotiations were underway and none were planned before the Monday deadline. And White House officials said, we've never invoked half-heartedly to break a strike. We're not considering doing it so now. The problem is they're going to have no choice, as we're going to see tens of thousands of workers hit the unemployment line starting at midnight. On average, it takes 1 week to clear out 1 day of port closure. As much as 43 to 49% of total containerized goods entering the U.S. are processed through the ports on the East Coast and Gulf Coast. So get this, if you can't get the stuff you ordered anyways, and you're waiting for it to be delivered until the strike's over, are you going to order more stuff? Not likely. This is a big problem for China's factories. But again, it's not just China. It's not just the U.S. We see problems in Germany as well. As German inflation now slows, or demand is what we should say slows, below 2% as the ECB rate cut bets rise, and that, alongside more gloomy signals on economic growth, is prompting markets to bet on a third reduction in the ECB's deposit rate on October 17, with investors putting chances at about 75%, because what we see is the U.S. economy is in danger. China's economy is on the brink of total collapse, and Germany's economy is right behind China's. This is a dangerous setup, but one setup we're very bullish about is a chart setup for our sponsor for today's show, Flex Shopper. You can find them on the NASDAQ under symbol FPAY. Let's take a look at who Flex Shopper is. And everything you need to know is in the pinned comment and description below, because they offer cutting-edge technology that enables a traditional retailer to offer their services and/or products to a demographic they weren't previously able to target, which is the subprime consumer. Our omni-channel payment solutions include lease-to-own e-commerce marketplace, on-site e-commerce payment model, and a mobile application for in-store point of sales. And let's talk about the bullish bet from insiders. Because while insider transactions are not the most important thing when it comes to long-term investing, logic dictates you should pay some attention to whether insiders are buying or selling, and they put up nearly 600,000 bets of their own money. And here we see the last 12 months, the biggest single purchase by an insider was the chairman of the board, who bought 134,000 worth of shares at $1.74 per share. That means even when the share price was higher than $1.13, the recent price, an insider wanted to purchase shares. And to us, this is very important to consider the price insiders pay for shares. Generally speaking, it catches our eye when insiders have purchased shares above current prices, as it suggests they believe the shares are worth buying even at a higher price. In the last 12 months, Flex Shopper insiders were buying shares but not selling, with the average buy price at $1.23. Keep in mind, it's trading at $1 now. This is why we set up that price target of a 23% gain. We're going to look at that chart again because this is a great setup. These transactions suggest that insiders have considered the current price attractive, and that is important if you're looking to make an investment in Flex Shopper. And usually the higher the insider ownership, the more likely it is that insiders will be incentivized to build the company for the long term, which is the focus, as right now insiders own about 11 million worth of shares, which is 43% of the company. And why are they buying? Because they believe their company is going to expand and bring in a lot more revenue, as Flex Shopper partners with Terrace Financial to expand merchant opportunities. Flex Shopper specializes in providing flexible lease-owned solutions tailored for underserved consumers and retail merchants across various sectors. By integrating Flex Shopper's LTO services, Terrace Finance further expands its payment offerings to include Flex Shopper's current and future financing options. These solutions are seamlessly integrated into a merchant's brick and mortar, point of sale systems, and e-commerce platforms. By providing additional payment solutions, merchant partners are positioned to expand conversion and increase repeat purchases. But it's not just Terrace Finance. They also partner with Versatile Credit to expand merchant opportunities. And here you can see the partnership integrates Flex Shopper's robust lease-owned services into Versatile Credit's platform, enhancing consumer payment solution options across more than 1,600 tire and auto retail merchant locations in over 30 states. In the second quarter of 2024, applicants via the Versatile Credit platform were approved for over 8.3 million through Flex Shopper. The company expects this will drive higher utilization rates across Versatile Credit's merchant partners and expand Flex Shopper's LTO solutions to new merchant partners. As a result, Flex Shopper expects to add 100 new retail locations per quarter over the next several quarters through its growing partnership with Versatile Credit. And the CEO of Flex Shopper had to say, "We're excited to deepen our relationship with Versatile Credit and help more merchant partners increase conversion to drive higher ASPs and grow sales." Now let's take a look at that chart, because one thing that we see that you can grow grow, and that is your net worth through Flex Shopper. Again, you can find them on the NASDAQ under the symbol FPAY. And here you can see when the stock trades down to the supply zone, which is marked by these two horizontal purple lines, buyers eagerly step in and drove it up. Here you can see more than a 23% return, where that horizontal orange line is the average price insiders are paying for the stock. You can see it happened again here recently. Buyers stepped into the supply zone, drove it up almost 23%, and here you see a nice big accumulation pattern building here at the bottom in the supply zone. With the stock trading right around $1 a share at the time of recording, we see a potential 23% return, putting a massive amount of money in your pocket. But as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.